If you looked at the headlines in late 2025, you probably saw a very specific picture of the Canadian economy. You saw the tariff threats. You saw the panic about manufacturing. You saw the prediction that the American economy was about to swallow its northern neighbor whole. And if you only looked at the political noise, that picture looked real. But while the cameras were focused on the noise, something else was happening in the background. Something quiet, something massive. In December 2025, right at the absolute peak of that uncertainty, one of the largest infrastructure investors on the planet made a move. They didn't pull money out. They didn't pause for clarity. They planted a flag directly in Toronto. We are talking about IFM investors. And we aren't talking about pocket change. We are talking about a fund managing roughly 242 billion Canadian dollars. That is $250 billion. This is the kind of money that builds national power grids. It buys airports. It funds the things that cannot fail. And when $242 billion moves into a high-risk zone, right when everyone else is screaming, fire, you have to ask a very simple question. What do they see that the headlines are missing? Today, we are looking at the ledger, not the rhetoric. We're going to show you why smart capital is betting that in a volatile world, Canada isn't the victim. It's the hedge. To understand why this money moved, you have to understand what it's running away from. For decades, the United States was the only economic engine that mattered in North America. If you wanted growth, you went to New York. If you wanted policy, you went to Washington. But in 2025, that engine started misfiring. And I don't mean a recession. I mean something scarier for a long-term investor. Unpredictability. Think about it. If you are a pension fund, let's say you're managing the retirement savings for a teachers' union in Australia, you operate on a 40-year timeline. You need to know that the rules today will be roughly the same in 2045. But look at the U.S. market recently. Tariff policies change by the tweet. Trade agreements are conditional. The regulatory environment shifts violently every 4 years, depending on who sits in the Oval Office. This is the volatility trap. For a hedge fund trading on volatility, this is great. They love chaos. They can short the market in the morning and buy back in the afternoon. But for infrastructure capital, the money that actually builds the physical world, this is a nightmare. Here is how that math works inside the boardroom. Imagine the meeting. The chief risk officer looks at the spreadsheet for a potential project in the U.S. The projected return on investment might be a healthy 8%. But then they look at the policy risk column. If a new administration comes in and slaps a 20% tariff on the steel you need to maintain that project, your margin doesn't just shrink, it vanishes. It goes negative. So, when the policy environment becomes erratic, investors add what is called a risk premium. They demand a higher return to justify the danger. But when policy shifts from stable to completely random, when a tariff might be 10% today and 50% tomorrow, that risk premium becomes infinite. The spreadsheet breaks. The model says, do not invest. It becomes a binary decision. It's not about finding a better deal. It's about avoiding a catastrophe. You cannot build a billion-dollar port if the trade policy governing that port might flip overnight. You cannot finance a 20-year energy grid if the subsidies are treated as political bargaining chips. Capital hates friction. But more than that, capital hates not knowing the rules. And this is where the narrative flips. While Washington was flexing its muscles and creating leverage through uncertainty, Canada was doing something incredibly unexciting. It was building a boring, predictable framework. And in the world of high finance, boring is starting to look like a luxury product. So let's talk about the whale that just surfaced in Toronto, IFM investors. If you haven't heard of them, that's by design. They don't seek attention. They are owned by Australian pension funds. Understand what that means. This isn't Silicon Valley venture capital chasing a 10 times return on some AI startup. This is the retirement money of millions of working people. Their mandate isn't get rich quick. Their mandate is never lose. So look at what they own. They own interests in global container terminals at the Port of Vancouver. That handles a massive chunk of Canada's Pacific trade. They own district heating and cooling systems that keep hospitals running. They own wave energy projects. These are what we call national arteries. And unlike other types of assets, they possess a quality that makes them incredibly sensitive to geography. Immobility. This is a crucial distinction that often gets missed. Think about a tech company or a light manufacturing plant. If the tax laws change in California, or if the labor market gets too tight, they can pack up. They can move their servers to Texas or Ireland. They can ship their machinery to Mexico. They are liquid. They can escape. But infrastructure is different. You cannot move a hydroelectric dam. You cannot repackage a transmission line and ship it across the border. A district heating system is miles of pipe buried 10 feet underground beneath a city. A deepwater terminal is concrete poured into the Pacific Ocean. These assets are married to the country they are in. They cannot leave. They are stuck there for 50 years. So when an investor buys something this heavy, this permanent, they are making a bet on the long-term sanity of that country. They are betting that the society around that asset won't unravel. They are betting that the government won't suddenly decide to nationalize the grid or rewrite the trade laws that make the port viable. When IFM announced they were opening a dedicated office in Toronto in December 2025, the timing was everything. Remember the context. This was when the tariff rhetoric was at its hottest. The pressure on Ottawa was intense. The Canada is broken narrative was trending everywhere. If IFM believed that narrative, if they believed the Canadian economy was about to be crushed by U.S. pressure, they would have stayed away. Instead, they doubled down. Why? Because they are calculating risk differently than the cable news pundits. They looked at the U.S. and saw a market where political risk was becoming systemic. Then they looked at Canada and saw an asset base that was insulated from that chaos. They didn't choose Toronto because they loved the view of the CN Tower. They chose it because in a portfolio worth $242 billion, you need a safe harbor. This move was a signal. It was the smart money voting with its feet. And they weren't the only ones. This brings us to the mechanism. How did Canada actually pull this off? Because let's be honest, stability alone isn't enough. You can be stable and stagnant. You can be boring and broke. The shift happened because Ottawa finally stopped trying to compete with the U.S. on subsidies and started competing on structure. This is largely attributed to the Fiscal Anchor strategy, or what markets have started calling the Carney Framework. The logic is simple. The U.S. government is running massive deficits to fuel growth. That creates inflation and eventually instability. Think of it like two different ways to run a business. The American approach right now is like running a company on a corporate credit card. You get massive growth immediately. You can buy whatever you want, but you are fueling it with debt. It's inflationary. It feels good now, but the bill comes later. And everyone knows the bill is coming. Canada's approach shifted. Instead of borrowing to spend, the goal became crowding in private capital. This is like funding your growth by bringing in equity partners. You aren't printing money. You are unlocking money that is already sitting on the sidelines. Specifically, that patient, private money we talked about. The concept here is the multiplier effect. For every dollar the Canadian government puts into de-risking a project, say by guaranteeing the price of carbon or backing a loan, they aim to attract $3, $4, or $5 of private investment. The target was audacious, unlocking nearly $1 trillion in private investment over the next decade. But how do you get that money? You offer what the U.S. won't. Certainty. Look at the specifics. While the U.S. debates the existence of climate policy every election cycle, Canada locked in a carbon pricing schedule and investment tax credits for critical minerals that extend beyond 2030. They created a policy runway long enough for a 20-year project to take off. If you are a battery manufacturer or a mining company in Saskatchewan or a logistics firm, that timeline is everything. It means you can sit down with your bankers and show them a model that doesn't break in 2029. It means you can calculate your ROI. This transformed Canada's role in the North American economy. We stopped trying to be the cheaper version of the United States. We stopped trying to out-subsidize the IRA. We became the reliable back end of the continent. We process the critical minerals. We provide the clean energy. We handle the logistics corridors that don't get shut down by political tantrums. It turns out, being the, quote, boring partner is a very lucrative business model when your main competitor is volatile. So what does this actually mean for the future? It means the map of economic power is being redrawn, but not in the way the loud voices think. We are used to thinking that power belongs to the country that can shout the loudest, threaten the most, and impose the biggest tariffs. And sure, that is one form of power. It's coercive power. It works quickly, but it burns bridges. But there is another form of power, attraction, the ability to be the place where capital feels safe, the ability to be the vault where the world stores its most valuable assets. The $242 billion bet by IFM is proof that Canada has that power, and they are just the first. We are seeing similar signals from European heavy industry and Asian pension funds. They are looking at North America, they see the heat rising in the South, and they are deciding that the North is where the foundation is solid. This isn't just about Canada versus the US. It's about a global flight to quality. When the world gets dangerous, money gets conservative. And right now, Canada is positioning itself as the most conservative, reliable bet on the continent. The tariff threats from Washington act like heat. And in physics, when you apply heat, things expand and move. Capital is moving away from the friction and towards the stability. This isn't to say there won't be pain. Tariffs hurt. The pressure is real. We are going to feel the impact of those trade fights. But the long game isn't about who wins the news cycle this week. It's about who is still standing strong in 20 years. And if you follow the money, the real money, the patient money, it's betting that Canada isn't going anywhere. In a world on fire, the most valuable asset you can own is the one place that isn't burning. Thanks for watching.